Congressman Brad Sherman, thank you very much for coming on today.
It's great to be with you.
Congressman Sherman, earlier in the year you introduced a series of bills that targeted Americans investing in China. It would end the tax credit that Americans get, the tax break that they would get for investing in Chinese stocks, the capital's gain tax. Can you talk a bit about why you introduced that?
We don't provide a credit for investing in stocks. We do provide a capital gains allowance so that people are taxed at only 20% on the profit they make investing in real estate or investing in stocks. And that's a lower rate than the wages earned by many Americans. Of course, the first wages you earn during the year are, or the first 20 grand or so you make is tax-free, and the next is it. But eventually most workers are paying 22%, 24% on their wages plus. So wages are taxed often at a much higher rate than 20%. And we do that because we want to encourage people to invest in stocks because that builds companies, and companies build the economy. But we lose a lot of tax revenue from that. And that might be justified or it might not be in terms of encouraging investment in American stocks. But why would we want to lose tax dollars to encourage people to invest in Chinese stocks? It's not our job to build the Chinese economy. And what's interesting is the People's Republic of China, they turn in their system to their citizens and give them incentives for investing Chinese stocks that they do not provide for investing in American stocks. So as long as China is going to encourage its people to invest domestically, we should not be encouraging people to take money that could be invested in our economy and invest it in the Chinese economy.
Where did those incentives come from in the first place?
The capital gains allowance has been in the tax code since well before the 1954 tax code. I think it might have been from the very beginning, maybe from the 1930s. But the first tax law that I studied was written in 1954.
And it included China specifically?
No, it's just all capital assets. So they never thought, well, okay, American real estate, British real estate, Chinese real estate, American stocks, Chinese stocks, British stocks. They just, at the time they were writing this, our economy was overwhelmingly domestic, particularly in terms of investment. And they didn't really think it through. And we do want to encourage investment, but it really shouldn't use American tax dollars to encourage investment abroad, but certainly not in, my bill covers China, Russia, Iran, and North Korea, although I can't imagine anybody investing in North Korea.
And so other than being, an authoritarian regime, what is the danger of investing in China, in the Chinese companies?
Well, as to the danger for the investor, that's another issue, but there's no reason for us to be forgoing tax dollars to provide a tax subsidy to build a potential adversary, certainly a competitor. Whatever term you use for China, closest friend is not one of them. So we shouldn't be subsidizing the building of the Chinese economy. Whether we should be subsidizing the building of the Canadian or British economies, we can talk about some other time. But we should first start with China, Russia, and Iran. The other thing is, as far as dangers for investing in China, I oversee, I'm the chief Democrat on the subcommittee that oversees all the protections for investors and the SEC and capital markets. And we need to do more to make investors aware of the dangers of investing in China, where expropriation could occur. And it could certainly occur if, God forbid, there were an invasion of Taiwan. An invasion of Taiwan would break the economic relationship between the United States and China. And one possible aspect of that would be a confiscation of American assets that the PRC had access to. Investors have to think that. They have to price that in. I'm not saying it's likely to happen, but stocks go up and down based upon possibilities rather than probabilities. I'm also concerned about index funds investing in China because the risks are there, and you should evaluate them one at a time. These index funds, they call themselves low-risk funds. low-cost funds because they put no effort into determining which stocks to buy. They just buy the whole index. And that may make a lot of sense as a way to invest, but China has unique risks, and I don't think index funds should be investing in China.
Congressman Brad Sherman, thank you very much for your time here today.
Thank you.